Good morning, everyone. My name is Scott Yoder. I'm from MidCap Advisors. Welcome to our conversation today regarding the impact of COVID on exit planning. We have a lot to cover today, but we are hoping to leave some time at the end to cover any questions you might have as we go through the presentation. As you notice, there's a chat or a question box on your screen, and if you have questions as we go through this, please just put those there, and then at the end of the presentation, we'll try to cover as many as we can, if not all. And if we can't get to any, we'll definitely respond post the webinar. In addition, we plan on sharing this webinar, including the recording and the slides, 24 hours after we finish up. So a lot to cover today. We are going to be covering exit planning fundamentals, proactive financial and tax planning, the trade-offs of selling to an insider versus an outsider, preparing for the company for sale, and some post-sale considerations of what life looks like after sale. So I'm pleased to be joined by a multidisciplinary group of professional and seasonal advisors: Al with Sax, Marie with Sax Wealth, and Paul with Bittiger, Elias, and Triolo attorneys. So thought we'd begin by just maybe Al, you can kind of introduce the firm and yourself, and then we'll go to Marie and Paul.
Sure. Thanks, Scott. Good morning, everyone. I'm Al Traverso, partner at Sax LLP. Been with the firm since 1996. I am heavily involved in our firm's manufacturing and distribution niche, and also our transaction advisory services group. Our firm has been in business for well over 50 years, with offices now in Parsippany. We just recently moved from Clifton, New York City, and Pennington, New Jersey. The firm's focus is on the family-owned, closely held business. So our niche is really working with the business owners themselves and helping them through their business issues. Certainly tax planning is a big part of our practice and what we do. But we also work closely with the business owners through their struggles and challenges. Certainly the current environment that we're in has presented a whole new host of challenges. But our firm has been very proactive in working with our clients. Perhaps some of you hopefully have participated and listened in to our paycheck protection loan services group. We have a task force that has been very active in providing information and helping to advise our clients navigate that particular program. But that's just one example of just how at Sax we stay proactive with our clients and help them with their business and their challenges.
Thank you, Al. Marie, do you mind introducing yourself and Sax Wealth?
Sure. I'm Marie DiCaprio, and I'm a partner at Sax Wealth Advisors, which is a wholly owned subsidiary of Sax LLP. Sax Wealth Advisors is an SEC registered investment advisor. We work on a fiduciary basis with clients, helping them with financial planning as well as investments without the sale of any kind of financial products. Our goal is really to do comprehensive planning with all of our clients, which includes for many of our business owner clients, exit strategy and what life after owning a business means. And we really try to look at all aspects of a client's financial life, whether it be estate planning, tax planning, investing, generational planning. And we do work very closely with our CPA partners on the Sax LLP side, really, again, bringing the full comprehensive picture to the clients that we work with.
Thank you, Maria. Paul, last but not least, would you mind introducing yourself and your firm?
Thanks, Scott. Yeah, my name is Paul Elias. I'm a partner at Bittiger, Elias, and Triolo. We're a small law firm, a boutique firm. Our offices are in Paramus, and we also have an office in New York. Our firm is strongly focused on serving business clients concerning nearly all of their legal needs. My personal practice area is really focused in transactional law, which is a lot of business buy-sells, mergers and acquisitions, professional transitions, do a lot of commercial real estate, loan refinances, and I do a lot of estate planning for my clients. My partners also represent clients in litigation matters, land use and development, construction, and so forth. Our philosophy is to bring a client into the firm and service them through myself or my partners in all their legal needs. We're focused on providing very high level legal services, but always keeping it as cost effective as we can.
Thank you, Paul. So let me introduce myself, Scott Yoder with MidCap Advisors. MidCap is a 20-year-old investment bank based in New York City. We focus on middle market businesses, mostly sell side representation of doing transactions from as small as $5 million to as large as $350 million. So without further ado, let's get started with the presentation. So we thought it'd be good to start with the exit planning fundamentals. As you'll see on the next slide, we wanted to really provide a framework. I think exit planning has been kind of a buzzword that's been around for a number of years now, and there's been a lot of webinars, been a lot of discussion around exit planning for business owners. But I think oftentimes, there's kind of a mystery around what exit planning really is and how do you really get started. So we thought it'd be beneficial to start by just giving everybody the framework of what an exit plan really looks like and how to get started on it. We think the first step is to really kind of answer 6 questions on the personal side. And if you can answer these 6 questions, which oftentimes you can't, it requires some thought, requires some reconciliation between the different answers, because oftentimes the answers you provide either are conflicting with one another or aren't reality. So for example, if you're a business owner and you say, look, I want to exit in 2 years and I want to get $50 million from my business, but that your business might only be worth $30 million today, and it'd probably take longer than 2 years to get to 50 million. You have to reconcile those 2 conflicting objectives. So the key, though, is to start answering these questions and then to build a team around you of advisors and have somebody to quarterback that process. But if you can answer these questions, they will provide the foundation for the advisors and really the compass to maneuver and to guide you along the way. So let's just walk through the 6 personal questions. The first question is, who do you want to exit to? This question is really about whether you want to exit internally or externally. Internally obviously means, management, family, employees, or externally could mean strategic buyer, financial buyer. So that's kind of question number 1. Question 2 is, what do you want to accomplish as part of your eventual exit? This is really about your aspirations associated with kind of the softer issues in the business. It could be that you want to reward some of your key employees as part of the transaction. It could be you want to find a buyer that will ensure that the business stays within the community. It could be that you have some family members that are up and coming, and you want them to continue in their progress as business leaders. It could be a whole host of things, but these are typically some of the softer issues. And then the third question is, when do you want to exit? Obviously, this is a somewhat intuitive question. This is really about the timing of when you want to exit, 3 to 5 years, next year, whatever the case may be. But then the fourth question gets a little bit more deeper into that same question, is how do you want to exit over time in one event? So oftentimes, I think a lot of sellers think that they can just kind of go to market, sell their business, and they can just kind of walk away. That case is available, but a lot of times it limits your options. And so, for example, if you really want to kind of maximize the value and maximize your options, private equity is obviously a big buyer these days. They account for close to 50% of all the transactions, and they have a lot of money that is pursuing quality companies. And if you get involved with the private equity, you'll have to stick around for a period of time, typically 2, 3, 4, 5 years, because oftentimes what occurs in those types of transactions is you'll roll equity as part of the deal, and so you'll want to be involved. They want you involved. They're typically not operators, so you have to kind of consider that. And the fifth question is how much money do you need from the sale of the company to meet your personal financial needs? Not your wants, but your needs. So as you think about kind of what post-life looks like post-exit and the kind of funds or finances you need to kind of figure out how much of that has to come from the company. That will, inform a lot of these answers in the reconciliation process. And then last, but not all least, is what does your life look like post-exit? Whether you're looking to start another company or whether you want to do some of the things that you've been not able to do because you've been focused on the business, whether that's traveling or picking up a hobby you've been wanting to do for years. But you really have to kind of figure that out prior to pulling the trigger on a transaction, because if you don't, there's oftentimes post-exit remorse that you wish you would have held on to it. So if you can answer those questions and try to work through that reconciliation with you, your family, your advisors, that is a big fundamental step that will go a long ways to completing a successful exit and to informing your advisors efficiently and correctly. And then on the business side, obviously there's always low-hanging fruit on how to maximize the value of your business. And so you need to consider those, and those will inform oftentimes the valuation exercise, the timing exercise, and so forth. And then lastly, planning far enough advance, there's often opportunities to eliminate, minimize the deferred taxes. So you need to, that has to be a major tenet in the exit planning framework too. So that hopefully gets everybody started and gets a sense of what we mean by exit planning. And obviously, we as a team here are all here and able to answer any more questions you have regarding this. So let's jump into kind of some of the details associated with a few components of that exercise. The first is financial planning. Marie, do you mind talking us through some of the components that you think are important as owners consider developing their exit plan?
Sure, absolutely. Thank you, Scott. So I think what Scott had, alluded to in his introduction, there is definitely a softer side to exit planning and planning in general that we as financial planners can help business owners with. The big thing is really thinking about, what comes next? What does your life look like after the business is sold? If you have spent, a good portion of your life and time and energy running your business, how will you spend your time when the business is sold? Do you still desire to have some time in the business, and will that even be possible for you? Will the new owners, want you to be involved in some way, shape, or form, and would you be okay if you are completely out of the business once it is sold? So these are things, it's a very important thing to think about. For many people, it actually holds them back because they haven't really thought about, what comes next? What will they do with their time? I think another thing that's super important to keep in mind now with COVID is, the idea of traveling and spending time with family has really changed. Whereas, we sort of took for granted that it would be, if we wanted to travel, go see family and do all those things, we could do so easily. And now it's really curtailing much of that capability, and perhaps for quite some time, we don't know. So, those are certainly things that will help you can spend your time on, but will you be able to do it and in the way that you want to be able to do it? So it's definitely something to keep in mind. And then you also want to think about, in terms of just general planning, as we age, as we get older, what does that look like if our health is not as good as we would like it to be? Do we have plans for someone to come in and take care of us? Who will take care of us? Do we have family that we can rely on? Will we go someplace where we can get care? I mean, these are sorts of the things that we want to think about as we go through life planning. On a more analytical basis, what we really want to look at is cash flow, and sort of this idea of, will you have enough? How much do you need to be able to retire and sell the business? So the number one thing, probably the most important thing you could do while you're thinking about selling the business is really understanding what your spending needs are. What you want to be spending money on, what it costs to run your household, all of those things that sometimes when we're very busy working in our businesses, we sort of know that there's enough money coming in and everything can be accounted for and paid for easily. But once you don't have cash flow coming in, you have to make sure that everything can get paid. So really understanding what your current outflow is, what your budget is. And then also adding in those additional things that you're going to be spending money on now that you have time, whether that be travel or hobbies, or we'll talk a little bit more in a couple of minutes about charity, family, gifting, all of those things. What are those aspirational things that you want to be able to do with any cash flow? You also want to take a really good look at things that perhaps the business was paying for that now you will have to be paying for personally, and what of those things you will need, including any kind of, insurance policies that perhaps you don't need anymore, or are more than you need. You may not need to spend the cash on that, and that will improve cash flow. So those are all the things that you want to think about when it comes to cash flow, which is, again, very, very important in the planning process. And then lastly, one of the things that we really like to talk about is legacy. Planning, how do you want to be remembered? What impact do you want to have on your family, your community? Some of the things to think about are charitable giving. Now that selling a business really allows you to unlock the equity in your business. And so what do you want to do now that you have this equity at your disposal, which you previously didn't have? So charitable giving and the ways that you can do that effectively. There are charities that you feel passionate about. Helping family, gifting to family, and again, the strategies and best ways to do that. Estate tax considerations, which, in an ever-changing political leadership environment, we want to be cognizant that these things do change. Nothing is set in stone. And so you want to be cognizant of, the type of planning that you can be doing to minimize estate tax. Some people consider things like a family vacation home or doing family vacations. Again, these may be curtailed by COVID because of everything, all the restrictions that have been imposed because of that. But this may be something that, again, is aspirational, something that you want to be able to leave to your family. And I would say, again, as a financial planner working with clients and their children is, to really organize and simplify your finances, really take the time to think things through, have things organized so that if anyone does need to come in and take care of you, or, when you are no longer here on this earth, that the people that are left behind are left with, something that they can manage and work with. So I think that is super important too, in terms of, what we are remembered by.
Thank you, Marie. So Al, I think as we laid out in kind of the framework, obviously one big item that I'm sure most owners care about is really kind of tax planning and how to eliminate, minimize, or defer taxes as part of the transaction. So I think that couple is with also deal structure and the implications of that. So Al and Paul, would you guys mind us walking through kind of the different deal structures and some of the tax planning aspects that the owner should start considering?
Sure, absolutely. Thanks, Scott. So I think before a business owner is ready to just enter into a transaction and considering a transaction, it's always so important to make sure that there is a plan. You know, when we're speaking with our clients, you know, we're always thinking about, you know, be prepared, right? That Boy Scout motto rings true for a sale of a business. You always want to make sure that you're ready just in case a deal does present itself, because you just never know when that's going to happen. And being prepared from a tax perspective means making sure that you've got a tax plan in place. And part of that tax plan should include estate planning. Many times the family business is, if not the most, it is a very significant part of the family's assets. And there are techniques from an estate planning perspective where you can shelter you know, the value that's going to be in the taxable estate of the current owners and pass that along. But the plan needs to be put in place well before there is a transaction that is now being considered, because many of those techniques depend on valuations at a time, you know, before there's a transaction, not when there's a transaction already in place or a transaction has already occurred. At that point, it is really too late to do any meaningful, effective estate planning once you're already at the negotiating table and a value for the business has been set or the transaction has occurred. So estate planning is really something that needs to be thought of now before you start considering entertaining offers or thinking about exiting from the business. But equally as important is, of course, Marie, touched on it, was, what the cash needs are. Well, I think it's very important before you are looking at the value of your business. It's important to understand what a business owner would get net if a transaction were to occur, and run a couple of different scenarios, run through the calculation. If you had a sale today at, pick multiple prices, whether it's 5 million, 8 million, or 10 million, whatever the value of the business that you're going to say is this would be the anticipated sales price. It's important to run through those computations and really see what does that mean that you're going to end up with in terms of net proceeds, because those are nice numbers, 5, 8, 10 million. But depending on the structure of the deal and depending on what obligations there are that need to be satisfied, where proceeds need to go to satisfy debt perhaps, or other liabilities, you certainly have to consider, well, there's the tax impact of this transaction, and what is that going to mean? Because that's going to take away from the sales price. There's also other things like transaction costs. And so what is really that net number? And now how does that net number tie into your financial plan? So running those computations, I think, is very important, so that you as a seller, fully understand that at a certain price level, at a certain sales price, whatever that value is that's agreed upon, where you're going to end up in terms of net proceeds. Because that's, at the end of the day, that's the most important number. What's the net proceeds? Next slide. And I think Paul's going to talk to us about just an overview from a legal aspect of the types of structures. Paul?
Yep, thanks, Al. So when you're selling your business, you're selling your company, there's basically two general sales structures that you're going to see. An asset sale, or an equity sale, or also known as a stock sale. An asset sale is when a selling company sells substantially all of its assets to a buying company. In this situation, the selling entity and the buying entity are distinct, and the buying entity is buying all of the assets, but not the company itself. It will look and feel like it bought the company, but there are two distinct entities at play. And in that transaction, nearly all of the assets are going to be included, and this will be, things from the equipment, the inventory, the supplies, the facility itself, the business name, the goodwill of every kind, the intellectual property. So nearly all of the assets that are used in the operation of the company will be transferred in the sale. Now, there are some exclusions, notably cash equivalents, accounts receivable, and there's also, in certain situations, assets not used in the operation of the business, for example, like an office or vehicle. On the liability side, liabilities are generally not transferred unless specifically assumed. So the buyer will have to specifically assume a liability. A common one will be a lease agreement, or certain contracts that the company utilizes in its operations. But if it's not specified in the contract, it does not transfer with the sale. On the other hand, we have an equity sale. And an equity sale is when the company itself is being bought by a buyer. So they're going to be buying the stock, or in the case of a corporation, or the membership interest in the case of an LLC. And in that situation, all assets and liabilities are transferred. Still, certain assets can be excluded, like cash and cash equivalents. However, receivables and payables will be included to a certain extent. All liabilities are being transferred unless specifically excluded. So it's a little bit different from an asset sale in that sense, where an asset sale, no liabilities are transferred unless included. On an equity sale, all liabilities are transferred unless excluded. Next slide. So why do one or the other? Really depends on the situation. But for an asset sale, the advantages are really, it's a simpler contractual process, and there's less in-depth and less complex due diligence. And this is really because it's a less risky transaction for the buyer, because they're not taking on liabilities, known and unknown. There's less of a need to do a deep dive into every aspect of the company. You're still going to see a fairly complex contract with due diligence, but it's scaled back from what an equity sale contract looks like. The disadvantage, and Al's going to speak to this more, but there could be a greater tax impact to the seller in an asset sale. Any unassumed contracts remain with the seller, so that the seller's going to have to deal with those after the closing. And customer contracts can be harder to transfer because we now have two separate and distinct entities, as opposed to the entity not changing. On an equity sale, the clear advantage to the seller is it can be tax favorable, and the assets and liabilities easily transfer, and for the seller, all the contracts get assumed. The disadvantage is, again, it's going to be a more complex transaction, and I think the biggest disadvantage for a seller is buyers are more reluctant to do these types of transactions because of the liability assumption component and the extra risk involved in doing an equity sale.
Okay, thanks, Paul. So from a tax perspective, looking at a asset sale versus a stock or equity sale, there are some significant tax differences that do need to be considered. On an asset sale, what you really would have is you're going to have elements of both ordinary income as well as capital gain income. And so what that ultimately does is it increases the tax burden on the transaction. And some things that would give rise to ordinary income versus just a capital gain scenario, which is what you would have in a stock or an equity sale, are things like accelerated depreciation from a tax perspective, depreciation, bonus depreciation, Section 179 depreciation. You'd have to recapture that on the assets. And so that becomes a factor that is going to come into play with the ultimate tax calculation on the transaction. Also, if we have a seller that, from a tax perspective, is on the cash basis, there are certain what are referred to hot assets that would trigger the recognition of ordinary income. So if you're on the cash basis, right, from a tax perspective, you're not recognizing your accounts receivable or your work in process. Depending on your business, you may have work that's in process, but you haven't billed for it yet, so it's not really part of AR, but there's still value because it is work that where value has been applied to it, and you will eventually bill for it. But those types of assets, if you're selling the assets of the company, and AR is one of those items that's being sold, that's going to trigger the ordinary income and cause that to be taxable at the ordinary income rates. So it becomes very important to understand in an asset sale what's going to be subject to the ordinary income rates versus the capital gain rates. And again, that's why it's important to run those calculations way ahead of time so that you as a seller are aware of what's the tax impact. Now, if we're dealing with an S corp or a partnership, these gains that are occurring, whether it's ordinary income, ordinary gain, or capital gain, all of that's going to flow through, and ultimately the tax is paid at the individual level. But some thought also needs to be given to the timing of when it's time to actually liquidate and close the entity. Because in an asset sale, as Paul mentioned, the entity really still exists. So your current company is still going to be out there. If you're selling assets, or you're not getting rid of the company that you currently own, it is still there. And so part of the computation and part of the strategy needs to be when is the right time then to also liquidate the company, because there could be tax traps in terms of the timing if the liquidation occurs at an inopportune time and it's not matched up with the recognition of the gains on the transaction. So it's very important to look at that timing as well. And a lot of what goes into that consideration has to do with, well, what's the basis, the shareholder, the current owner's basis in these entities? How much basis is going to be left even after proceeds are distributed? So it may become very important to make sure that you've aligned the timing of the liquidation of the entity to be coordinated with the timing of the transaction. So something else just to keep in mind that's out there. Now, on a stock sale, it's pretty straightforward, or an equity sale, it's going to be capital gain rates. And of course, that is again also reported on the shareholder's tax return in the case of an S corporation or a partnership. And then, of course, as Paul mentioned, that entity would continue. It's just going to be owned by the buyer at that point. Next slide. So there are other nuances to exiting a business that we see quite frequently, where perhaps maybe you have a deal and the buyer wants to structure it in such a way that they want to buy the entire entity. They want to buy the equity of the company, but the buyer does want to make an election to treat it for tax purposes as an asset sale. And so what would that really do? Well, in effect, for the seller, it would be just that. It would be as if it was an asset sale. And so it would trigger additional tax because you would still have that element of ordinary income mixed with capital gain income, and it does create a higher tax burden for the seller. So typically you want to know what that difference is, because you want to be able to bring that to the negotiating table in terms of your ultimate selling price, to try and, negotiate a higher price to account for those additional taxes that are going to result if the deal is ultimately structured using this technique of making this election from a tax perspective. So, certainly working with your advisors, you really want to understand not only the tax impact, but what's the buyer, what's their structure, how do they want to, commence the deal, in order to understand really what value should you be asking for, what you should be asking for at the negotiating table. Also, we also see sometimes it's, that it's a merger. And certainly if it's a merger, that opens up a whole host of other considerations. And there are methods from a tax perspective to make that most tax efficient in a merger. Now, we've been talking about taxes and capital gain and ordinary income, and that, predominantly we all think about federal taxes, but you can't also forget about the state tax considerations. And state tax considerations certainly come into play not only in the home state, but if the entity that you're selling has locations, has physical presence, has a warehouse or another manufacturing facility, and they're in other states, we've got to take a look at what are the tax consequences of selling the business, and how much of the income, how much of the gain needs to be allocated and reported in those various states. Specifically on an asset sale, or if that 338H10 election is made, it's going to be just as like it was an asset sale, and so therefore the state considerations need to come into play. So there's a lot really to consider from a tax perspective. Now, in a C Corp world, if you are currently a C Corp, I would strongly recommend having a conversation with your tax advisor about making an S election. Really would want to understand why a C Corp would be the better structure. There are instances where a C Corp could be more advantageous, depending on when the C Corp came into existence. But you want to make sure that you've covered that, and that you're not going to be leaving money on the table due to the double taxation. If you do an asset sale with a C Corp, it's going to get taxed at the C Corp level, and then when you distribute it out, it's also taxed again. If you're thinking about making an S election, you want to do that right away, because there is still the concept of the built-in gains, which has a 5-year window under the current tax regime. So what does that mean? That means that essentially if you made an S election today, but you did a deal and you did an asset sale, it's still going to be taxed at the corporate level, even though you're technically an S Corp, because those gains are considered to be locked in and essentially effective and tied to the entity while it was a C Corp. So you're not going to get out of the double taxation if you're still within that built-in gain window. So making that S election as quickly as possible is certainly something to consider. Next slide. Other elements of a deal, what we see sometimes are earn-out provisions, where the sales price is struck, but it is broken up into, basically two tranches, where you'll get a piece of it up front, but then there are earn-out provisions that are tied to achieving certain benchmarks for earnings, or perhaps a sales target. Have to be very careful here, because this is a potential tax trap. One of the requirements from a tax perspective, if you have earn-out provisions, you have to consider and allocate the basis of your assets or your stock, whatever it is you're selling, however it's structured. You do have to allocate the basis between those two tranches of funds. So an example is, if you had a deal for 10 million, and your basis, let's just say your basis is 5 million, and what you're selling, you got a 5 $5 million gain. But if you're only going to get half of that up front and you're going to get 5 million, well, then you have 2.5 million of basis applied in year one. And then the earnout provisions, which could stretch out over the next few years. Here's the tax trap. If those benchmarks that you need to hit, those provisions, whether it's a sales target or an EBITDA target, whatever it is, and you don't get the other 5 million, or you get something less, you still have that other half of your basis that is left out there, that would be applied against whatever proceeds you get. The risk is, though, if the targets don't come to fruition at all, you're left with that basis hanging out there in subsequent years, and you're just going to get a capital loss on the remainder of that basis, and you're going to get to take $3,000 a year for the next however many years it takes to recoup that basis. So that's a real risk when considering entering into a deal where there are earnout provisions. Contingent consideration is what it's commonly referred to. So something you definitely want to take into account. And I would certainly suggest, if you can, you'd want to minimize how much of that is left on an earnout basis versus getting the money up front. Other things that could impact, the net proceeds and what you're going to get, the working capital of the company. This is something that a buyer takes a very hard look at, and what that essentially refers to is how much money needs to be invested in the company in order to make it run. What's its working capital needs? So that gets to accounts receivable, inventory, and payables, as well as potentially debt. So anything, the higher the working capital needs, that is going to impact value. That's going to impact proceeds that you're going to get. So really what you want to try and do is look at what's the true working capital needs of your company. And you need to take a hard look at what the average working capital has been for the company over the past couple of years. If you're carrying too much inventory, if your receivables are taking too long to collect, all of these are, kind of negatives from the buyer's perspective, which are going to ultimately impact the selling price of the company. You really want to present your company as a efficient and clean opportunity. And one of the ways that you can increase ultimately the net cash that's going to come to you is to make sure that your receivables are clean and being collected as quickly as possible, making sure you're not sitting on too much inventory, that the inventory is turning, and that you're managing the working capital as best you can, so that from a buyer's perspective, they see it as a cleaner opportunity. Balance sheet adjustments, other things that are on there, if you've got items sitting on the balance sheet, employee loans, bad receivables, you have old obsolete inventory, you have fixed assets on there that just really aren't being utilized, and they're just sitting there and they're old. All of these things, really should be adjusted. You'd like to have this all cleaned up and adjusted before the due diligence, really occurs, because when a buyer comes in and they're looking and they're doing, their inspection, the more things that they find, the more the red flags start to get raised, and you really just want to try to minimize that as much as possible. Other things to consider, I think Paul's going to touch on later about, payouts or any other contingent employment agreements. And of course, don't forget that debt and what's going to need to be repaid. It's a big piece that often when we see, business owners and they have a deal on the table and they see that $5, $8, $10 million number, they're thinking that's what they're getting, and they really forget about what it is that sales price and what those proceeds are going to need to cover.
That's great advice, Al. From personal experience, for my father and for a lot of our clients, tax planning is so important. And if you really plan far enough advance, there are significant and creative ways to save enormous amount of dollars. in deal structure and in just the planning aspect. In addition, I really like, the focus on net proceeds and not sales price, right? The net proceeds is after debt, after fees, after taxes. That's the real way to evaluate the opportunities in comparison between your different options. So thank you so much, Al and Paul. Paul, do you mind just walking us through kind of in a very quick basis, we're already short on time, some of the kind of considerations and trade-offs of selling to an insider versus an outsider?
Sure. So when you're looking to sell your business, your company, there's a few classes of or targets of buyers that you can look to. So first, when you're looking at insiders, this is typically a key employee or key management. Common place to look to start your search, see if there's a potential suitor for your company. And this typically works if there's an obvious heir apparent in your company, that person that's been with you for a long time, working their way up management, knows how to run the company. This can be very advantageous. You don't need to go out and put your company on the market. It can be an easier negotiation process. You don't really have to help as much after the closing. So it can be a really obvious and clear place to start. I'd say one of the disadvantages I see, not always, but this could often involve a form of seller financing where that management or that key employee will want you to carry a note or carry, some sort of obligation after the closing. Moving to outsiders, I'd say one of the biggest potential buyers is going to be a financial buyer, private equity. These are often the suitors for larger companies. They can give you much better valuations. You're often dealing with an experienced and professional team of lawyers, management, transition. They're a lot more seasoned, and they're often self-financed, where you don't need to be working with a bank that's going to be involved trying to write a loan to buy your business. I would say a disadvantage, and it's not really a disadvantage to some, but that it will often involve a post-closing employment obligation, and usually for a significant period of time. And I say it's not really a disadvantage because for some sellers, they're not ready necessarily to retire. They just want to sell their business, and so the ability to continue to work for 1, 2, 3, 5 years is actually an attractive feature, but to some it may not be. There's also a strategic or a competitor that you could sell to. So what I mean by this is, this could be a direct competitor. This could be an upstream industry participant, so let's say one of your suppliers, or it could be a downstream industry participant, one of your customers. And this is a common way to find a buyer without ever, going to market or hiring a business broker. And there's a lot of advantages here. I'd say primarily it can result in a premium valuation for your company because your competitor or your supplier or your customer may experience a greater value from acquiring your company than, let's say, a new entrant to the industry. The biggest disadvantage, the biggest problem we run into is when you're doing a deal with, let's say, a competitor, the due diligence and legal process always involves revealing a lot of confidential information about your company. And when you're doing that to a competitor, that can make a lot of people uneasy. So it's just something that we work through. We do have confidentiality provisions, certain stages in which we release certain information, but that's certainly a complicating factor. Lastly, I would classify this category as new entrants to the industry or new entrants to ownership. So these are sales where you have an individual or a small group of individuals that are coming into the industry new, that want to buy a business and operate in that industry. Or you could have an individual or group of individuals who work in the industry and now want to transition to ownership. So these transactions often involve smaller companies. They're often brokered by business brokers, and they often involve bank financing. I'd say an advantage is banks do finance these deals a lot. the SBA will finance these kind of transactions a lot. And there's even, depending on your industry, conventional financing available from major banks to do a transaction like this.
Thank you, Paul. Sorry, I was on mute for a second. I think it's a great overview. I just want to point everybody back to kind of the 6 questions on the exit planning framework. If you can answer those, that will definitely guide and help you kind of pick the right exit channel for you. So, Margaret, we're getting short on time, so I thought we'd maybe jump to the PPP section, and if we have some more time, we'll come to the beginning. But I thought it was an important piece to cover here, during these kind of unique times. On it, a lot of folks have received a PPP loan, and there's obviously some kind of areas that we need to cover on that if those that have those are considering a transaction. So, Al, would you mind kind of walking us through how a PPP loan might, what you have to consider if you're considering a transaction?
Sure, absolutely, Scott. Thanks. So yeah, companies that have a PPP loan and you're considering entering into a transaction, the SBA back in early October did issue some guidance surrounding this. And essentially, when you have a 20% or more equity change or a 50% or more of the assets or a merger is being contemplated, the lender is going to have to get involved here. And from the perspective of the lender, if the loan is paid off before the transaction occurs, then there's really no restrictions at all. But you may have to get the lender involved, and if there is a sale or other transfer of equity less than 50%, or the sale is greater than 50% of equity or greater than 50% of the assets, you're going to have to think about putting some funds in escrow, essentially funds in escrow at closing of the transaction equal to the PPP loan. The SBA wants to make sure that it's protected, and until forgiveness is actually achieved through the SBA, and you've gotten the SBA sign off and approval, not just the bank's okay regarding approval, those funds are going to need to be held in escrow. So, and if you don't want to do that as the seller, then you're going to need to go to the SBA and get approval from them, and that request could take up to 60 days. So, again, the timing of the transaction, and if you have a PPP loan, you're going to need to reach out to the lender and see what the requirements are going to be for having those funds held in escrow. And then, of course, the order of the day is going to be go for forgiveness as quickly as possible. But if you do end up selling the company, as a seller, you just need to be aware, if you sold the stock in that type of a transaction, even though you've sold the company, understand that the SBA still has recourse against you as the former owner, since you were the owner when the PPP loan was taken out. So you're going to want to make sure that your agreement that you have with the buyer does have the appropriate language in there, and that you have the right protections for yourself regarding the liability for this. Because once you've sold the company, you need to make sure that the new owners are going to do the right thing in terms of the forgiveness application. So you're going to want to protect yourself there. And so that's the impact that the PPP does have on these types of transactions now.
Thank you, Al.
Scott,
Paul,
I would actually like to add one thing that I think related to PPP, I think that owners should be aware of, that there's a lot of SBA loans out there that owners have taken. And what I've seen is a lot of people don't realize is on certain SBA loans, they're putting liens on the business. And if you go to sell your business and you took an SBA loan with a 30-year repayment period, it most often has to be repaid at the closing of your sale. So that's something people should keep in mind as well.
Great. So, Paul, I apologize for jumping around here a little bit, but Margaret, do you mind just going back to the beginning of this section, and Paul, you can maybe take us across the finish line with these last 2 slides on preparing the company.
Sure. So in preparing the company for sale, one of the things you should look at is looking at your key employees, key management, and are they under employment agreements? And this can be important, and not just are they under employment agreements, but what those employment agreements say. This can be beneficial to the buyer if there is at least some sort of assurance that some of the important management or employees of the company won't leave right after the closing. On the other hand, you want to make sure that these agreements are not so long-term that a buyer would be stuck, for lack of a better word, with key employees or management that they might not otherwise want for such a long period of time. More importantly, are restrictive covenants with your key people. Buyers want to know that they're not going to buy your company and immediately one of the key people at the company is going to leave and take customers, take referral sources, take employees, and so they'll be looking for restrictive covenants with these people. This could be a standalone agreement, or it can be built into the employment agreement, and this is about assuring that the goodwill of your company remains intact for the buyer. Second, and probably most important from a legal standpoint, is doing a review of your company for legal issues and compliance before you even jump into the process of selling your company. Buyers are going to do extensive due diligence. They're going to ask you for a broad range of representations and warranties. Any issues you're having are going to probably come out in the contractual process. So you want to ask yourself, do you have any pending or threatened litigation? If you do, it's better to resolve it before you bring in a buyer for a sale contract. Are you having a dispute with any type of local, state, or federal agency? This could be, an issue you're having with the town, an issue you're having with the state. Again, it's good to resolve that. Are all your employees being paid properly? Do you have employee handbooks? Are your IP rights secured? Trademarks, copyrights, work for hire? Do you actually own your IP? And I think something that's new that sellers really need to be cognizant about: are you compliant with the COVID mitigation requirements? Do you have your protocols in place? Are people following them? And are you up to date with the latest requirements? Governor Murphy here in New Jersey just issued an order last week putting new requirements on businesses on how they protect employees and customers. Do you have those in place? Because once you go through the sale process, if you're out of compliance or you have these legal issues, it can become a very big issue for you in the middle of trying to close a deal.
Well, thank you so much, Paul, for finishing us out. I apologize, guys. We didn't get a chance to even finish the last section. Margaret, do you mind just going to the last page? So, as I mentioned at the beginning of the presentation today, we will be sending out this webinar and the recording to everybody that attended today. And so feel free to reach out to any of us individually or collectively if you have questions or you want to discuss further any of the content. But thank you again for joining us. I appreciate your time, and I hope it was helpful.